And as a professional paper, generally the trend is it has two sections. First one is 50 mark. Second section, there are two questions, okay, 25 marks each. Okay, so 100 marks, and the first section, which is 50 mark one, is quite critical. And the best strategy is that often candidates feel that they don't know much about this paper or this section, and it is unfamiliar, but often they discount their overall understanding and the effort, because you don't have to know probably all of these 50 questions. Even if you know well 35 mark or 30 mark, still it is good enough to attempt and fetch whatever you can, because since it is 50 mark and one question, there is a quite likelihood that you might not be familiar or aware with every single part of this question. There will be 3-4 sections, and you can still fetch most of the score. So moving on, this section will have 3 core discussions. So basically it is an investment appraisal, and we deal with the investment decisions using IRR, payback, M.IRR, and it is one of the favorite area of the examiners. Almost every time in every paper, this chapter is a frequent visitor. In one way or other, this area will be tested. So let's be enthusiastic and motivated to learn this one well, because it will be worth the time spent. So as an introduction, investment, financing, and dividend decisions are taken across 2 areas, either with the financial manager or even the treasury. Treasury manager support the finance manager, just as an additional point. But when we are deciding about the investment of the project, we take into account various expenditure, and in this chapter we'll learn what are the key aspects to consider, such as debt financing. What is the cost of capital? Because we are talking about the investment here. So every investment will come up with a cost of capital. Second is dividends. This is the return of the investment to the shareholders. And finally, we also consider what are the different types of expense, depreciation, inflation, sunk cost, and opportunity cost are, and how they impacted investment decisions. And it is a very interesting chapter in a way that it will help you making the decisions in various aspects of life, not only in the finance paper. Because if you want to say invest into a project, or you want to build a factory, and you might have invested already say $1 million in doing the research, legal consultation, etc. Now somebody comes and asks you that, oh, you have already invested $1 million and this project might not be fruitful to proceed. Would you still like to go ahead with this investment, even though it might not be fruitful, just because you have spent already $1 million? An answer is no, because whatever you have already spent to understand something, that is a sunk cost. Now, there is another way to look at this. If you're planning to build a factory on your own land, and land normally earns $100,000 every year to you, question is, would you ignore that aspect, that $100,000 is still can be earned if you just rent that piece of property or land to somebody? The reality is that you should consider that as well as one of the opportunity cost when you are doing the investment appraisal. So here in this chapter, we are going to talk about what are the different type of expense, the cost, the inflation rate, cost of capital, all these different kind of percentages, and how to treat that when you are making an investment decision. Often you make the decision about your studies, you're going abroad or starting a business, entrepreneurship, all this requires an investment appraisal decisions. What we use in those aspects of life is applicable here in this paper, and we will deal with each number. So before we move to that section, let's just quickly talk about how it is related. So investment appraisal actually takes into account the free cash flow as well as the economic return. So here we will talk about the IRR immediately after the NPV. And when it comes to the free cash flow, this is about the calculation of the cash flow for the purpose of investment, and this is also used to calculate how much dividend will be left to distribute or how much free capital is there for investment into a new project. So this is the overall map. As we will make the progress, we will talk about each section one by one, because if I just introduce you all these terminologies, it will be confusing. But this is just a chapter map for all these topics that we are going to cover here, like dealing with inflation, dealing with taxation. We are going to do this. Okay, so we can bypass this one for now. Key concept in investment appraisal is free cash flow, because the investment appraisal methodology heavily rely on the cash flow, not on the fictitious charges. Let me tell you why. Because if you get depreciation, right, that can help you save the cost. But when you're deciding for investment into a project, the depreciation or any notional charges like this is not considered as a cash flow. NPV is purely based on the cash flow, because cash flow is calculated for year-on-year basis, and we take the present value to calculate the net present value of any cash flow. So the key concept in the investment appraisal is that we factor only free cash flow, and it's not only for NPV. It is same for IRR, same for payback method, or even M.IRR. What is M.IRR? Modified investment internal rate of return. So for all this, we just consider the net cash flow rather than any other number which is not a real cash flow, like depreciation or amortization, right? Because that's bound to happen anyway. If you have purchased an asset, a truck or a vehicle, it's going to depreciate, right? Whether you use or not. But here, our discussion and debate is whether or not a particular investment should be started. If you have, say, bought 5 trucks, and imagine a pandemic, okay? Let's put this in context. So you already bought 5 trucks at the start of this year, thinking that there will be great business of transport. Pandemic is spread, and then the transportation is blocked. Now, at this juncture, you might consider that, okay, can I do some local activity? Can I move some commodity from one place to another place without involving much of the people, so infection is not spread? At that point of time, your focus should be to look at how much extra cash are you going to generate if your business is run successfully. And in such situation, we should not look at how much depreciation of the truck is going to take place, because you have already bought this and it is not the real cash flow. Hence, we ignore any such fictitious charging, and we only consider actual cash movements. Before I move on from this topic, please let me know if there is any question or doubt, because you should be 100% confident of this approach and comfortable as well using. So no fictitious charges, no depreciation, nothing is considered in this. Sunk cost is not considered, but opportunity cost is considered. What is sunk cost? Something that you have already invested into, something that you have already spent, that is sunk cost. It is cost incurred in the past, and you can't undo the past, you can't change that, so that is not considered. Opportunity cost is what? if you had invested the same capital, if you had invested the same land or factory for any other purpose, you might also incur some money, right? That money is called opportunity cost. For example, you are living in your flat, which is worth 1 crore or $1 million, right? There must be some monthly rent that you could have collected if you were not residing there. That money that you could have collected is called opportunity cost. If you are doing any appraisal for your own investment or business, you need to consider how much rent you could have generated. Okay, so that's the uses of free cash flow. Few other points as a basis of evaluating potential investment projects. That's the use. Why we should consider this as an indicator of company performance. Let me just plug in the charger. I am set now again. So as an indicator of company performance, why? Because there are, if you'll study the equity valuation, you will see that FCF, free cash flow, and then free cash flow are also of two types: free cash flow to firm and free cash flow to equity shareholders. There are two types of free cash flow. These are used to assess the performance of the company on per share basis. So FCF divided by the per share, you will see how much per share you are getting the free cash flow as a performance of the company. Now the question that you might have, why don't we assess the P&L or the profit rather than the free cash flow? Why don't we look at the return on per share only? Why this new guy FCF per share has come in the picture? It is because it is easy to manipulate return. Don't you agree? P&L, right? It is easy to manipulate. But free cash flow, it is hard to manipulate. And even in the case a company is having high sales or some difficult market, the cash flow is something which can give you more realistic picture of what is happening in the organization. Hence, this is used also as a performance measure. Of course, not everyone use this one, but still it is one of the popular measure. To calculate the value of a firm and thus has a potential share price. See, if you can calculate the free cash flow, then you can remove some of the annual expenditure or new project requirement. You can calculate the dividend, right? Dividend for the year. If you have the free cash flow calculated, if you can calculate the dividend, then you can calculate the present value of all the dividend that will be incurring to the organization, and it will be equal to your price. So this is used to calculate the price as well. Now, calculating free cash flow for investment appraisal. How do we calculate this free cash flow? All the revenue minus cost and investment. Because the word free cash flow means the first, your profit minus investment, because you need to sustain the organization, right? You can't just keep selling, reduce the cost, and do not grow. You need to grow as well. You need to do some capital investment, R&D, innovation, and for that you need to have some investment. So revenue minus cost minus investment, that is your FCF. What are the different investment appraisal methods? Remember, we'll deal with this in a great detail, right? But here, and it will be helpful for you to remember as well, I'm just introducing key number here at a very high level, because we'll go in further details. Net present value, As I said, year 1, 2, 3, 4, you'll have certain cash flow. You need to take the present value of that. So that's a high level concept of net present value. If that cash flow, including the initial expenditure, if your net cash flow is positive, it is a worth pursuing. Internal rate of return, this is the percentage rate which makes your NPV 0. So IRR is a rate which makes NPV 0. So that's called internal rate of return. And it assumes that whatever the cash flow is coming later years, you are using that cash flow at the same rate, which is the IRR. So that desired or that hypothetical rate at which you will target to invest your cash flow year on year is IRR. Of course, then we have modified IRR, which says that, all right, you can't invest the cash flow at that same hypothetical rate. It is not practical always to invest that particular cash flow at the same rate year on year, right? What is the best practical approach? You need to invest any cash inflow from year 2, 3, 4, etc. at the cost of capital of the organization. Because remember, when you're making any investment, you are also borrowing from the bank or somewhere. And then you have a cost of capital. If the cash inflow starts, right, when you're lucky, you start to get the cash inflow, your first preference will be to reduce your borrowing or return the capital, right? If you return the capital, then your best rate to apply here is cost of capital for any dollar generated. So if you are reinvesting everything at the cost of capital, then the rate of return that you generate overall at the project is called modified internal rate of return. We'll talk about that again in more detail. Discounted payback, this is simply when you get the cash flow and after first year, second year, you get all the cash flow, take the present value of all this cash flow and see how many years it will take you to get entire cash that you had invested. So let me take an example to simplify this. I made a investment in year zero of $10,000. First year, second year, third year, I have some cash flow. Okay, so 5,000. Second year, 7,000. Third year, again 5,000. And let's take a present value of all this, taking a hypothetical rate, say 10%. Okay, so at the rate of 10%, how much it will be? So something like say 4,500. This one. At the second year, we have the cash inflow, which will be 5,300, right? And third year, I take another 10% present value. This will become something like 3,000. Okay, so altogether we have the present value first year 4,500 plus 5,300. How much? It is still 4,800. Sorry, 9,800. We still don't have 10,000 recovered. So 9,800. Then we will take some part from 3,000, and we will see that it will be almost 2.1 year, basically, when you will get all the $10,000 recovered. So that's your discounted payback methods. Okay. So this is how we calculate discounted payback. We'll again discuss in more detail. Duration is the interest rate sensitivity rate. So duration is called interest rate sensitivity. We'll revisit these guys again in more details. Okay. So NPV, we need to see some practical examples. And what are the steps to calculate? Relevant cash flows are those cost and revenue that are future and incremental. Great points. So as we discussed earlier, anything that is past, we don't consider for NPV. Future cash flows are only considered. And if the organization already running and you're getting, say, a couple of $1 million from project A, B, and C, that is not relevant. If you are thinking about a new project D, if you're thinking about making a robot and you already have 5 chain of restaurant, right? You are getting 1 million from each 5 restaurants, but then you're thinking that, okay, if I use some robot, each restaurant will earn extra $500,000, right? Then when you're making the investment for developing that robot powered by artificial intelligence and data, what will happen? You don't have to look at the 5 restaurants current income, okay? $1, $1 million, etc. Again, $1 million, $1 million. You don't have to consider this income, okay? Because this is already coming. This income are already coming to you. You need to only consider incremental. So what is incremental? You are going to earn every year from this 5 restaurant $500,000 extra. That is your incremental income. This guy I'm talking about. This is your incremental income. Okay, from 5 restaurant you get additional $2.5 million. Wow, fantastic! And once you develop, it will be for eternity. For next God knows how many years it will continue to flow, right? So that incremental income you have to only look at, additional. And imagine your investment was $100 million. Okay, so that incremental income is what you have to consider. So $100 million is negative, right? Negative cash flow. And then you have to consider this $2.5 million every year. Let me introduce another interesting concept here. Oops. So $2.5 million for eternity, right? And how do you calculate something that comes to you for eternity, forever? Because $100 million you are investing now, and I'm saying 2.5 million will come from all these 5 restaurants forever. How do you calculate a cash flow which is coming to you forever? There is a way. It is called perpetuity. Cash inflow for perpetuity. Cash inflow for perpetuity. Sorry. Perpetuity. That means it is for eternal. That means you need to still find out your cost of capital for the company. Cost of capital, because of course, when you invest this $100 million, it is not free. Somewhere you have to borrow it from. So let's take an example. You borrow it at the rate of 10%. So 10% is your cost of capital or cost of financing. So when you need to calculate the present value of the infinite cash flow, you need to just divide this cash flow by that cost of finance. 0.1. This is 10%, right? So 0.1. Hence, in this case, your investment would be like 100 million minus plus $25 million. You are likely to make a 75 million loss. Okay, it looks great that 2.5 million will come for perpetuity, and it is just great to use this, but you can make a loss on this as well if the initial outlay is huge. Now, discounting, concept of discounting, how it works. Because all the cash flow which we are talking about here, we are discounting, right? Generally, all the future cash flow which will come. So discounting are of two types. Whenever there is a project, let me introduce a PPT, easy to explain. Maybe this will work. So discounting is used when multi-year cash flow is concerned. How? Say, for example, first year you invest 100 million. And actually year 0, you invest 100 million. First year, you have a cash inflow of 20 million. Second year, 25 million. Third year, 50 million. Fourth year, another 25 million. And fifth year, you have 20 million. Plus, you think there will be 20 million, 25 million of scrap value. So you are going to sell your asset and investment basically in fifth year investment, which is likely to generate in today's value $25 million, right? So what you need to do, so $25 million in today's value, and let's say for the ease, use 10% of the factor, discount factor or cost of capital. So you need to compound this number as well. You need to calculate everything in today's term, in today value. So while you quite agreeably calculate this 20 million to present value at the 0, or let's say now, right, using 10%, how much it will be? So that will be like $18 million. You calculate this guy as well at the value of now, again using 10%, how much it will be? So it will be something like this: 25 divided by 1.1 to the power 2, right? This is what you use. So that should be something like 19 million. Okay, let's use this one. Again, rate is 10%. How would you use? 50 million rate of 1 plus 10%, right? 1.1, 10% to the power how much? Third year, right? You are compounding back for 3 years. So 3, right? And this is going to be again like 33 million something. Okay, this is how you calculate the present value of everything. So when you're calculating the present value of all the future cash flow, you also need to factor that how much this 25 million is likely to be in the future using the inflation. So inflation rate is say 15%. Okay, that is in rate of inflation. What will happen to an asset which is 25 million now? And imagine that for the sake of easiness, it is not substantially depreciated. So what will happen to that? Its value will be 25 times 1.15 to the power 5. So that will be around 50 million. So here you need to also, with 20, you need to add 50 million and take the present value of all this together. Now, 100 million minus 100 million plus all these guys, 18 million, 19 million, 33 million, you need to keep adding. So 18 million plus 19 million plus 33 million, and let's just take around the number 17 million, and then 50 plus 20, 70, and present value in today's term, that will be like 45 million. So ultimately you will find out that project has made a gain. Let me do a quick math. So it seems to be something like 32 million. Okay, $32 million of profit, or the NPV, has been generated. So this is a way to calculate the cash flow, take the present value of the future cash flow, factor the inflation at the future date, and then take everything to, again, present value, subtract it from the investment that you made, and that is your net present value. So this is how discounting is done. This is how inflation is adjusted. Any question? Is that clear? Okay, going back to the PDF. So what have you covered? We talked about discounting, we talked about compounding. Compounding means here the terminal value, the 25 million, which is the value at current date. We calculate the using inflation. We factored inflation, and then we do the present value. So that is done. Present value of single sum we have calculated. Present value of perpetuity we have talked about, right? And this is something that we need to also discuss. Present value of an annuity. What is annuity? So imagine after the retirement, somebody gets 50,000 rupees per month, or 50,000 of any currency per month. And how many installment? Quite likely, suppose 100 installment is given. So 50 of 100 installment, and there is a rate to take the present value. Let's use our popular rate, 10%. So this is called annuity, because there are fixed number of installment, fixed number of amount, and the rate is also given. So in that case, we call it, and if I need to take how much all these money going to be valued in today's term, if I start to get 50,000 rupees every month for next 100 installments, or for say net 8 years, how much it will be worth today? That is calculated using present value of an annuity formula. Applying this, how do we use? So annuity, what is the annuity amount? 50K. So that is annuity, okay? Times AF. What is AF? It is like this. 1 minus 1 plus R means here we have to use decimal. Don't forget, don't use 10%, 10. Use decimal, 1.1, because decimal is 1.1 in here. And subsequently, so this part is done, 1 plus R has been done, minus N. Whenever you have minus N, that means it is 1 upon that factor. So minus N, how much? We have how many installment? 100. And then use the rate, which is 0.1. So generally be careful about the rate, because generally when we see 15%, we are tempted to use 15. No, it should be used in decimal always. So if it was 15%, I would use 1.15, sorry, 0.15. That is how we need to use rates. So in this case, 50K times 1 minus 1.1 to the power of 100 divided by 0.1. That will be the calculation for present value of an annuity. So to introduce the concept, how all this formula and the terminology works, these are the basics that we are going to use in NPV calculations. Now, advanced annuity for perpetuity, we add the concept of annuity and the perpetuity together, because generally whenever you have any installment, say 1K dollar that you get for next 100 forever, and cost of finance is 10%, you just divide the installment, say 1,000, by cost of finance. You get the present value for something that you are going to receive for perpetuity. So this is how perpetuity work. Delayed annuity and perpetuity, will consider that when we go through the annuity related problems. So discounting back and applying factor, this is very similar to all these steps. We'll just understand through the problems. Moving on, let's do a couple of questions fast. Let's understand the inflation. So generally, when imagine we get a salary, suppose next year, okay? So somebody who is earning 1K or $100,000 this year, okay, and you get a raise of 10% by your company, then we get $100,000, right? Is this really that we are getting a raise of 110 or sorry, raise of 10%? No, this is a nominal raise. This raise is something which has inflation already been built into this. That's why it is called nominal rate. What is the difference between the nominal and real? So the inflation 1 plus I, generally when we talk about the inflation rate is very high, it is like this. The 1 plus R, which is the real rate of growth, times 1 plus H, which is general inflation rate. So that gives us the, let's call it N for nominal growth. So nominal growth is equal to real growth times 1 plus inflation. So if I see that any country is growing at the rate of generally say 5%, then it is considered 1.05. What is the inflation rate? 1.1. In this case, it will become 1.115, like this. This will be the actual growth rate. What is the inflation then? -1. If you do -1, then you get a nominal rate. So 11.5 is the nominal rate. So whenever you find any nominal growth, and whenever we talk about 10% growth in salary, 10% growth in the revenue, these are nominal. We need to adjust nominal for real and inflation. So that is a formula here. 1 plus I is nominal or money, what we generally talk about. R is the real, H is the inflation rate. We use in the appraisal as well. Any questions so far? For the purpose of project, there are two types of inflation that we use. One, generally, the question will make it easy. It will give a general rate of inflation, which means cost of goods, sales, revenue, salary, everything is going up by 10%. It's 10%. That is general. But sometime you have a difficult question. It will say cost of good was up by 10%, but the sales was up by 5% because of the inflation only, right?
I mean,
salary was up by 15%. So you're saying something? Please proceed.
If you see.
Sorry, repeat. Are you fine with this? So there can be specific rate of inflation as well. Because in any economy, not everything goes up at the same rate. Real estate is going up maybe in your country at a different rate as compared to the salary and as compared
to
So all rates could be different. That is called specific inflation rates. You need to choose specifically which rate to apply, and it will be given in the question, by the way. Simply just a matter of practice. You need to identify and have a habit of applying the right rate.
Was staying worthy where?
I think, sorry, somebody has dialed from iPhone. You're breaking, your voice is breaking. I'm not able to hear, sorry. Okay, so we can move ahead. Calculating the free cash flow of a project under inflation. Let's take some example. This is also a very theoretical model. It is telling us how to deal with inflation. So one way is to, as I said earlier, if your revenue is given, cost of goods are also given, then you just multiply everything by 10% or maybe the specific rates which is given. Okay, that's one way. So use nominal method. Inflate each cash flow by its specific inflation rate. Okay, so use all these specific rate to inflate the numbers, right? And discount using the money rate. And then you need to discount them, right? Is that confusing? Let me give you a better example, or maybe simple example. So imagine that you completed ACCA and you got your first job, okay, and you're making your own P&L and balance sheet, something like, you want to do a mental math of calculating how much you will be able to save and how when you'll be able to buy your own house, etc. So what you generally do in that case, you have something like this. All right, so I'm going to earn 10 lakhs, or let's use a $1 million, okay, to start with. And then your expenditure would be, say, 0.5. So you're going to save 0.5 million every year. Now, the second year, third year, quite likely you are going to see increase in your salary. So it is going to increase 1.1 and 1 point, it becomes 2. Okay. So this is how this guy will grow your salary. This expenditure, I think it is going much faster, right? So that will be having a different inflation rate. So this one is becoming 0.7 and almost 0.9 in the third year. Subtract it. How much you got? 0.4 saving. So see, your saving is going down. And here you have 0.22. So first year, when you have less salary, your saving was higher. Second year, when you have a growth, your saving is lower. And the third year, when you are earning almost 1.12 million, your saving is even smaller, right? You're getting me? That is because inflation rates of your salary is different. Your expenditure, your cost of living is much higher, and your ultimate saving is much, much smaller. I can't help, right? But it is a fact. Now, how would you calculate all these numbers? So suppose that I have 4, 5, 6, 7, 8, 9, 10, this many years, right? And you expect to buy a house at the 10th year of your career. So you'll continue to have some numbers like this, right? So just imagine that now you have a very static saving, 0.2, 0.2, etc. every year, right? Agree? Now, in order to know how much you are going to have in today's value, 10 years later, in today's value, how much you're going to have, you need to take a present value of all this cash saving, right? And that is, when you check with your any economist, they'll say that you need to take the present value at the rate of 8%. So you start to calculate it back. 1.08 to the power 2, then 1.08 to the power 3, so on and forth, and you found out a net present value which says you're likely to have $3 million in 10 years in today's value. Now you think, oh, okay, that's fine, I can buy a house in 10 years. because that's the value of the money that you're going to save in 10 years time. So point I'm trying to make is you have to always use different rates for different purpose. They will never fall into the trap of using one single rate across all the different factors, right? Your salary is going to grow at a different rate, your expenditure will grow at a different rate, and your present value that you need to use, right, that will be different one. That's what it's saying here. Discount using the money rate. What is the money rate in this example? I used 8%, right? The economics told me to use the money rate to discount the value of money in today's term, that is 8%. Inflation for salary growth was 10%. Inflation for your cost of living was almost, I think, quite high. That was 20%. So use specific rates. That's the best thing. Keep checking which rate to use. That's right hand side, money nominal rate. Now let's go to real method. Real method is what simply? Real method means you're not going to consider inflated rate. Okay, you are going to only consider the real rate first, and at the end, because you need to convert everything to maybe nominal value, you can consider whether you need to calculate in the real or nominal. So let's take an example. Real method means your salary is going to grow by 8%. Generally for everyone you hear that it is 10%, but when you say real method means you have already adjusted for the inflation. So the inflation in your country was 2% and your salary growth was 10%. How much is your real growth? We talked about this, and let me highlight. It will take a couple of practice. So if your salary is growing at 10%, generally it is nominal rate, also known as money rate. So whenever your growth is, salary growth is 10%, and imagine your inflation rate is 2% or 3%. So you just take like this, 1.02. That's your inflation. And here comes your real growth, 1 plus R. So after doing all the math, you'll find out R is approximately 8%. It could be something like 7, 9, 8 or something. So let's take an approximate 8%. Because, and high level, if you want to adjust, your nominal rate is equal to real plus inflation. If you're trying to use the real method, then you need to subtract inflation from nominal rate, because your nominal is equal to real plus inflation. So when you want to take real, it is nominal minus inflation. That is the magic. So use real method. Do not inflate the cash flow, because remember, you are using real method, and real, what you're doing, you have already subtracted the inflation. You don't want to factor inflation when you are using real method, because real is the actual growth. Imagine this way. You don't want to hear that what is the overall growth of the economy or the salary, because you know that when your salary is going by 10% and your cost of expenditure, like same amount of goods that you need to buy like last year, that also grown by say 2%, then what is your real growth in the salary? Only 8%, right? Quite intuitive, quite logical. Imagine you're getting pocket money last year, 10 rupees from your house as a young kid. And next year, you are given 12 rupees every day. But then you found out that the same chocolate or biscuit that you were able to buy in 10 rupees last year, now it costs 12 rupees. That means there's no growth. So real growth is 0. In a simple way to understand, right? There could be also a situation that your pocket money increased from 10 rupees to 12 rupees, but the biscuit has increased from 10 to 13 rupees. So you have a negative growth actually in your pocket money, because you can't buy the same biscuit anymore. So real rate is also important, and that's the meaning of real rate here. So don't use the inflation to inflate anything here when you're using real rate. Second, discount using the real rate only, because now you hate inflation rate. You need to use consistently real rate only. Okay, so after discounting, whatever you get, it is in the real term, real value. Okay, and be consistent. This is the formula, actually the recommendation to remember, because whatever you are using, if you're using money rate, use money. If you choose the real rate, use real rate consistently. Don't mix and match. In the nominal rate, don't use real, or real rate, don't use nominal or inflated rate. Your answer will be wrong. Now we have a question, a fantastic question here. But by the way, before we move, do you have any question? Feel free to ask, don't hesitate. It is not exam, not interview. Any question? Okay, so let's attempt and check how much we understood. A company is considering investing 4.5 million in a project. Why my pen is not working? In a project to achieve an annual increase in revenue over the next 5 years of 2 million. Remember our rule of thumb, increase in revenue. That is the part of the question here. So we have to consider only the incremental rate. Okay. So basically, let's understand all the fundamentals through the question. I think some of you might have been late to start. So as a company is considering 4.5 million of the investment, only incremental revenue to consider for the next 5 years, and that is 2 million per year. Okay, there are some rules given how to calculate. The project will lead to an increase in wage cost of 0.4 million per annum, PA per annum, and will also require expenditure of 0.3 million per annum to maintain the level of existing assets. So let's highlight this one, this one. These are the cash flow you have to factor when making tables. Additional investment in working capital equivalent to 10% of the increase. Let me, before going to the solution, give you some tips how to treat these numbers. Okay. And the key is company is considering investment of 4.5 million. So let's say you have a table like 0, 1, 2, 3, 4, like this. 0 year. Whenever you have initial investment, that's called cash outlay. That is negative 4.5 million. Project is annual increase in revenue over the next 5 years. Okay, so we are going to increase the cash every year, 2 million. But I think there is some other trick. Additional investment in working capital equivalent to 10% of the increase. Okay, that's for the working capital. So we can keep it as it is. So 2 million of additional cash flow is going to come from this investment of 4.5 million. Now the project will lead to increase of wages. That will be 0.4 million. So, and will also require expenditure of 0.3 PM. So let's have 0.4 million for wages, and then expenditure of to maintain the assets. Okay, so let's say asset maintenance, that will be 0.3 million. Because if you don't do that, you cannot sustain the business. You want to increase continuously the 2 million of revenue, and whenever you have to I mean, if you have a greed or you have the aspirations to increase your cash flow, you also have to continuously oil the system, right? Means you have to invest something continuously. What are those investment? You have to invest extra into the asset. Maybe you need to buy more infrastructure or the or the instruments, and you also need to have more people. So the wage cost will be increasing, and we are only factoring not the total. We are just factoring everything as incremental basis. Don't think that the wage cost of 0.4 million is the total wage cost of the organization. No, it is only for incremental basis. So we are just adding all the incremental amount. Additional investment in working capital requiring 0.10% of the increase in revenue will need to be in place at the start of each year. Okay, so basically we need to keep adding some 10% of the additional revenue, so 0.2 million. Okay, so working capital, again this is incremental, 0.2 million we need to add every year. And what are these numbers? All negative because they are expenditure. This way we'll just take the total sum, 2 minus 4 3 7 8 9, so 1.1 million approximately we have positive cash outlay. Similarly, on the second year, how we do? Let me see if there is any inflation. Seems all the same number, so 1.1 million, so on and so forth. You have this number repeated year on year, 0.4, 0.3, 0.2, just for the sake of concept building. Okay, 1.1, 1.1, repeated. And here you have negative, right? Don't forget the negative cash outlay. And then you have 1.1 million for next 5 million for 5 years. Approximately you need to now take the, actually not approximately, you need to take the present value of all this number, right? But before we do that, let's consider the full question which is given here. This one was easy to just put a structure in place that how it is calculated. Now, once you have understood this much, we will make it a little more complex. We'll add inflation to every number and little more complication, but good to stepwise understand this. Hope you are fine with this much. Now we will add some complications. What are these here? Revenue. You remember we talked about the specific inflation, right? For each number, each items, you need to apply a different inflation rate. Here it comes. Revenue increasing at this rate, wages 5, asset 7, and so on and forth. Okay, let's continue with this. The real cost of capital of the company is 8%. This is something to do discounting. So remember this one. All cash flow are in the real terms. Ignore tax because we have a question for tax treatment separately. Find the free cash flow of the project and determine whether it is worthwhile. Okay, so start with 10% of inflation. What do we observe from our questions? Let's see. If we had not factored the inflation, how it would have looked, 2 million each year. Now, this was without use of this table. So just to help you connect now, this becomes 2.2, and since now this is 2.2, it will be 2.2 times 1.1. Apply this concept here. So we are applying 2.2 because 2 million is split at the rate of 10%. Then this 2.2 again, 1.1, that becomes 2.20 times 1.1, this times 1.1, so on and forth, right? Easy? You keep inflating all this number at the rate given here. Now, increasing the wage cost. Wages are increasing at the rate of 5%. Let's see how much was the wage cost, 0.4. So if I just factor that 0.4, 0.4 times 1.05, how much? That becomes 4.20. Again 0.05, you'll find all this number, 1.05 times 1.0. So every year you just need to multiply this by 1.05 and you'll find new numbers because of the inflation. Subtract the wage cost from the increased revenue and you find out the operating cash flow. So far, not everything is done. You just have operating cash flow because you still need to do the investment in the factory in order to keep increasing your revenue. That's why you have to factor those as well. So 1.17 so far. New investment, I think we had already factored here 4.5 million at the year 0. So see, new investment already here at year 0. That's already done. Asset replacement spending 7%. And don't forget that first you need to make the asset replacement spending. And why it is done? Because if you have, say, a large factory and you are manufacturing sugar, right? Don't you think there will be wear and tear for new capacity that you have created? And if there is a wear and tear, you have to replace that as well. And more machine is used, more and wear and tear. So basically, your machine requires to have certain level of maintenance and wear and tear. Plus, that wear and tear replacement will also be subject to the inflation. Imagine that the country is going through the inflation anyway. So every year that replacement is also going to be more expensive. So that is inflated at the rate of 7%. And the number that we already had here, 0.3. Apply the inflation to that and it becomes 321. Now you say that I had 0.3, but here it looks 321. It is because all these numbers are here given in 1000. So 321,000. Okay, that is 0.321 million. So I had 0.3 million. If you multiply that by 1.07 to adjust the inflation, it will be 321. Okay, so everything is in 1000. So 321 again times 1.07 times 1.07, you will find all these numbers. Fast forward, working capital injection. You need to have working capital. What is the rate? Is that inflated? No. What is happening is working capital is required just 10% extra every year. So 10% extra means 220 in the first year. Why? You remember here comes your revenue. You target to have 2.2 million of revenue, right? So 10% of that, you need to have 1st January 2021. First was 21. If you need to have 2.2 million of revenue, you need to at least have 10% extra working capital invested today now. So that 2.220, you have to keep it here. Now, be careful. When you invest into working capital in the year 1, you don't spend entire working capital, right? It is like you buy more goods in December and in January you spend, you buy more goods in December, in January, and then you spend. So basically, you don't have to every year invest extra in the working capital from the start. You just have to invest once and it will carry forward, right? Because every time when you're selling goods, you are also buying back. Okay, so working capital investment, whenever the NPV calculation requires you to invest in the first year and then just look for the additional working capital. You don't have to invest into working capital every year or every month. Okay, be careful about that. So why we have this $22,000 extra? Because the question has asked you to ensure that you always have 10% of the next year's revenue, right? So 10% of next year revenue is changing here. For T2, you need to have 242, right? 242. Let's take 10% of 2.42 million is 0.242 working capital. What you have invested in invested earlier? Only 220. So you have to invest additional gap. So 242 minus 220 is 22, right? 22,000. Hence, you need to invest 22,000. Similarly, next year, 2662, you need to invest additional 24. So you just need to make additional investment into working capital because your revenue is going to increase year on year, right? So on and forth. Finally, what happens? Why you get this much positive guy? Because ultimately, the 2221 that you had targeted to invest and the project is closing down in the last year, you just get all the working capital back. Because you remember, you are always having additional inventory in your stock for the next year, right? 6th year, there is no project. The question stops at year 5. Because 6th year, there is no project, that much working capital that you were always keeping ready, now you can go and sell in the open market. So that 322 becomes a positive cash flow. Simple game. Now take all the plus minus, do the shall I just clean it? It will look better. So if you just take all the plus minus, ultimately you get all these numbers at the end, right? When you get all this number, you need to do the discounting at present value factor of 15%. So the first year, on the current year, there is just no discounting required, but for next year, it becomes 0.870 of the factor, and 756 here. So how do we get it? 1 divided by 1.15, that becomes 0.87. Then 1 divided by 1.15 to the power 2, that will be 756. So when we are doing for 2 years, and then we'll do for 3rd year, which will become 658. We multiply this number with this, and we are getting this much. So this is telling the first year. It's actually geo year number. So present value. So every year's present value is calculated. And finally, we get NPV of 1.389 million after adjusting this negative cash outlay. So the net cash inflow taken at the rate of 15% at the present value, still it is higher than the initial expenditure that was made, and it was higher by 1.389 million, not a small amount. So ultimately we see it is making difference. We can take up this project as long as, how do we make the decision? What is the value of this? As long as your NPV is smaller than or greater, actually greater than 0, you can take up the project, because it is saying that this is just to understand the importance and the value out of this discussion and the calculation. This is saying that even if you factor all the loans, cost of loan, expenditure, interest, borrowing, you factor all the additional staff, the rent, every single thing, still you are making money. And that money could be $1, $2, or in this case, 1.389 million. So as long as your net present value is greater than 0, you can take up the project and you will not be in loss. That is the crux and the meaning of this entire calculation. Okay. Now, cost of capital, we used 15% because this here 8%, which we represent as 1.08. What was that? This is the real rate of borrowing that we need to use for discounting times the rate of inflation, rate of general inflation, in fact. So this is giving us nominal rate for discounting. So 1.08, 1.06, it becomes 1.15. So how do you take the rate? -1, it becomes 15%. This is the rate that we are going to use for calculating the present value of all these number. PV factor 15% that we used. That is present value factor at the nominal rate, because we have done all the calculation considering the inflation. See the inflation rate we have used. So when we use when we take the cost of capital, we need to use nominal rate only, not other. Let's take a step to discuss. Okay. Let's take a step to discuss the cost of capital in a more fundamental way. I'm clearing all this earlier drawing. Okay. Tell me a couple of things. Are we factoring inflation in calculating NPV? Answer is yes, right? Then what is the nominal rate of capital? That would be 1 plus real rate times 1 plus inflation. The question is, if we had calculated our entire project at real rate, okay, then we could have used only real rate for taking the present value to as a discount factor to discount everything, right? But did we use the real rate? No. How do you know? Because we have used we used inflation to kind of inflate the cost of wages or the entire expenditure, right? We were factoring inflation. So whenever you factor inflation, that means your entire NPV is on the basis of nominal rate. Whenever you take inflation into account, that means you have chosen to go through the nominal rate. Okay. And you have to be consistent. You can't use nominal rate in one place and real rate in another place. Because we need to use inflation as per the question, we also need to use nominal rate for everything. When you use nominal rate so when it comes to the discount factor or cost of capital, then we need to use nominal rate of capital. And nominal rate means multiply 1 plus real rate, which we are given. I think that's 8%, and then multiply by inflation, which is 6.5 something percent. Right now, the cost of capital. So cost of capital is third, generally given in the question. If you have a good project, if you're going to make build robotics in your restaurant or in your factory, you need to do some development, R&D expenditure. So you go to bank and bank will charge you 10% or 8% as per this question. And that rate is your cost of capital, because that is the rate you have to bear, the cost you have to bear to get the additional finance for your project. So that cost of capital is required. Then you have to check whether it is real or nominal, because eventually if your all calculation is on the basis of real, then you can use real. If you are using inflation in your calculations, then use nominal. If you have to use nominal cost of capital, then use this formula. Okay, make sense? Back to the PDF. And here we are doing the same, calculating the cost of capital using inflation rate. Here in this question, we are having a company which plans 7 million in a new product. Net contribution for the next 5 years is expected to be 4.2 million per annum in real terms. Okay. It seems they are using real cost of capital for the company as 6%. Do we have inflation here in this question? The following forecasts are made for the rate of inflation each year. Yeah, it is quite similar to the earlier question that we had. And in the interest of the preparation, let's attempt this question so that all the concepts are solidified in our mind. Let me copy this question for our PPT. It will be easy to use there. Because NPV kind of questions are almost sure to come every time, and we see this as a frequent visitor. Now, can you see this question? Hope you can see my PPT, right? And the question here, which we can refer in case we start to forget the questions. A company planned to invest 7 million in a new product. Net contribution over the next 5 years is expected to be 4.2 million per annum in real terms. Marketing expenditure is 1.4 million. Expenditure of 1.3 PA will be required to replace existing assets. And then we have all this rate of inflation. So moving to the second question, part, 7 million of new investment required. So let me have year 0, 2, sorry, 1, 2, 3, 4, 5, 6. I think that should be enough. contribution, and then marketing expenditure. We have inflation rate given 8%, and I think for marketing it was 3% as well. Okay. So 1.3 million per annum will be required to replace existing assets, which will now be used on the project but are getting on the end of their useful lives. This expenditure will be incurred at the start of each year. Interesting. And that is going to be inflated by 3% every year. So marketing cost 1.3 times 1.03, which should be around 1.45. So let me calculate. Should be 1.4. How much is the contribution? 4.2 million per annum, and contribution is going to be inflated at rate of 8%. So let's calculate the first year first here. So 4.2 times 1.08, that should be, what is my calculator saying? 4.536 to be precise. Okay, that's good enough. 4.536. Let me make some boundary. Now what I'll do, year on year, I'll just multiply by respective rates. 8% here, right? Applicable 8%. This is applicable 1.44. What will happen? This becomes 8, 9. In fact, 3 decimal place, 9. This is becoming 485. I'll continue to just combine this. 5.291. Then actually it should be all negative. All negative. This could be a common mistake sometime. We might make great progress, but sign can be often dangerous. 5714, and lastly, let me use this space. We have only 1 year left. 1623. $6.171. Now I think all the signs are good. T1, how much we got? This is 3094. 3415. No, 4. Now we come to the point, we need to check what else we need to do. Anyone having any idea? Any suggestion? So far we have not factored the T0 number. Asset, which is for year 0, and 7 million. By the way, this should be all clearly demarcated with decimal. Everything is in million. Asset replacement or working capital. So working capital. How much do we have? What the question is saying. Additional investment in working capital requires equivalent of 10% of contribution. 10% of the contribution. So 4536, 10% of that. How much? Since it is year one, then we have to make the investment in the first year itself, 0 year itself. So that becomes 0.4, sorry. That should become 0.454. Here it becomes 0.48. In fact, actually, I should just take the balance. Okay. This is something good. A good mistake I was going to make, in fact. So 454 is already invested, and I need to achieve how much? 0.489. 0.489, the 10% of this. So how much is the difference? Okay. So let's consider this as a working. You need to sometime also do the working and get into the habit of creating the working as well. So working one. Okay. So 454 is already done. Year 1, 454 already invested into the working capital. Second year, how much I need? 489 means 0.489. So 489 was needed. The balance should be 5 and 6. Is that so? No. So that would be actually 3. So 36, and everything is in million. So point like this, 0.036. That is my year 1 additional investment needed. Now year 2, how much do I need more? Let me see how much is this. 0.529. So 0.529 minus 489 we have already achieved so far. So that should be 1129. So around 40. Let's say 40 in terms of decimal of million is 0.04. Year 3, again I have to look at 571. 571 minus this year 529, 30 or 41. That becomes 42. So for year 3, I have to make similar 0.42 million of investment. Year 4, how much? 617. So how do I make this? 617 minus 571. So almost 47.47. And in the year 5, I think there is some good news. In the year 5, everything will be released. So 617 that we had prepared for, that will be released. 0.617, but this time this should be really the positive. All others, these numbers has to be negative. Okay, so plugging them back, actually this becomes how much? 36. 0.442. So what is happening? .036, 0.04. Again, let's say roughly 0.02. And then finally 0.617. What happens to the asset side? At the asset front, we have 7 million of an investment. Is that going to go up? No. But asset will be replaced by 1.3 million. So we have to make an adjustment for the asset. So asset is 0.7 is done. I think there's some error because of the touching. Okay, before I keep moving, just to check with you, are you getting the idea how we are making the adjustment? I think there's some patches because of the touchpad. We have done for working capital. We have to make a working capital note like this, and then have another one. Another working capital will be required for asset investment. Let's call it W2 and make a number crunching first, working 2. And what we need to do is asset replacement. Asset replacement will be done as year 0, 1.3 million. Year 1, this should be simple enough. We have to just keep multiplying by factor of 1.04. Okay, simpler job, good news. 1352. Year 2, again factor by 1.04, then it becomes 1.06. Again factor of 0.04. 3. Let me just do more math. 1.046. How much? 1.462. Year 4 should be 1.520. Year 5. Do we need to make any asset replacement for year 5? No, because we have already have enough for year 5. We don't need to prepare for year 6, right? So at the end of the year 5, we don't need to make any investment. So let's forget about year 4 and stop at year. Let's forget about year 5. Stop at year 4. Because we are always, when we are making the investment into the asset, we are in a way preparing for next year. What happens in the year 5 for the working capital? Whatever the inventory that you had, you are selling in the market. It is a positive cash flow. Every year you are investing into the working capital. It was negative cash flow. But year 5 for working capital, you have a windfall gain. You had additional cash coming. In the same manner, when you had to calculate the asset replacement for year-on-year basis, when your project is going to terminate in that year, you can just ignore. You don't have to make any investment because you're not preparing for the next year. Because the working capital, asset replacement, these are working, 1 year in advance. So when you go to the final year for such numbers, think, do you really need to make an investment? Or maybe You just need to ignore that here. Or could be you are in a very positive situation, you're going to get additional cash. As it is happening in the working capital, you're going to get additional cash, but in case of asset replacement, just ignore. Back to our calculation sheet. Okay. I forgot what was the number here. So just to remember, starting with 1300 in the year 0, then 1352, 1406, 1352, 1406. Replacement, just give one word, replacement. So it is a negative cash flow, so 1.3 million, then 1.40, 1.352, 406, 1.352, 1.406 negative, then back here 520, 1.520, and do we need anything else? Something happening. Okay, 462 is also needed. 1.520, 462, then 1.520, and nil here. Any other working needed? We can just keep a space here. We'll see if any other working needed. But back to this sheet. It looks okay. A couple of numbers we can punch. 1.462, 1.520, and nothing here. Great. We are in a situation to calculate free cash flow, FCF. So year 0, we have 3 people, 0.7, 454, 1.3. That's it. And that comes to 8-8.753. Next one, positive 4536, negative. So we already have this, guys, so we can just rely on this positive. So this minus 0.036 minus 0.352. How much? That becomes, it should be positive number, 1.706. Similarly, I have to just look at this, minus 0.042 minus 1.406. That becomes 1.97. I think so. Yes. Here, similarly, it comes to be 2.57. So this is the one of the most cumbersome calculation in terms of the focus, but then we also have good marks generally in NPV calculations. It is a good scoring question, right? It requires patience, but it's worthwhile. So 58, I think there's some decimal place can be corrected if I calculate twice, but it's great enough. 6171, 1.623, just one number required. 5.165. Done. Okay. So let me just introduce for the sake of simplicity what we need to do as the next step. Now we have free cash flow. Okay. What we need to do, we don't have to make much calculation anymore. No cost of capital, nothing. So no expense, no inflation. We have done everything. Now easy part comes. And easy part is that you have to decide what should be my present value factor, what should be my discount factor, right? And at this stage, I want you to shout out what should be the formula to use, or maybe just tell me, did we use inflation? Yes or no? Did we use inflation in the formula? I think the answer is yes. Which inflation rate or which discount factor should you use? Real or nominal? Because you use inflation, you cannot use real. Cut. You need to use inflation adjusted. Nominal means inflation adjusted. Yeah. And how we can calculate this? Let's go back to question. Simple thing. Additional investment, working capital equivalent to 10% of the contribution, and real cost of capital of the company is 6%. So additional investment in working capital equivalent to 10% of contribution will need to be in place at the start of each year. Okay, working capital will be released at the end of the project, which is fantastic. And what is the cost of capital? Real cost of capital is 6%. Be careful with the word, and it is quite clear. Real cost of capital, right? So we are not going to use it as it is. We are going to use this, but not as it is. And we can use inflation, which is for the general prices, 4%, 4.7%. Okay. Let's use nominal rate of discount or cost of capital, you can say, or cost of capital, which means nominal cost of capital, is what? 1 plus real times 1 plus inflation equal to 1 plus 6%. 6%. Where is this? 1.06 times 1 plus 4.5. Yeah, 4.7. So 1.047, which is 1.06 times 1.047, which is equal to almost 1.11, something like this. So minus 1, it is 11%. Let's take a rounded number, 11% as the rate of discount. Do we agree or disagree? If you disagree, let's vote. So 11%, right? Based on the real rate and inflation rate. Plug in here. Great. So it seems everyone agrees. So now you can confidently say, let me put another. So if I were to make a discount factor, what I'll do, I'll make my work easy. Okay. And I'll first calculate every year's discount rate. Normally for 0 year, it is 1. Year 1, what is the discount factor? 1 by 1.11, because it is 1 year discount factor. Yeah, that becomes 0.901. Second year, 1.111 to the power 2. It becomes 0.812. Third year, 1 by 1.11 to the power 3. It becomes how much? Get my calculator. 0.731. Fourth year 1 by 1.1. Oops. 1.1.114 becomes 0.659, and the fifth year becomes 0.593. So let me memorize 901812. Okay, 1901.812 731,659. Oops, for some reason it was deleted. Anyway, it was first year 91812 dividing by 11%. There's another way to calculate. If you have 731, just divide by 11%, 0.11. So I'm just calculating it, 659 and times 593. Okay, if you continue to calculate all this, it is now giving you present value. So 1.706 calculated by 0.901, you are getting the present value. Similarly for this and this, so on and forth. That means you are going to get the present value of all this number. A great deal of calculation is already done. As a result, I'm putting that one by one in my calculator. Now we can just simply put it in terms of year 0, 1, 2, 3, 4, 5. Starting with 0, first year, I had a negative cash flow, 8753, 8753, and now my calculator says 1537 1.599 1.650 1.695, and finally this becomes 30. Right. 306, something like this. I have to just sum up everything, and 8753 most. So these all these numbers, remember, it is in terms of year 0. Okay, even though I'm putting 1, 2, 3, 4, 5, 6, this means everything is calculated in terms of year 0. Now, remember, this value is at now, not in future. It's at the moment. At the moment, you have invested negative 8.75 million, and you are going to get all this cash flow, which if I add together, it's 8 million, 0.8 million. But still, it's a positive number. Starting from here, all the way to the different steps, and we land at, what is important is that we calculate the working capital, the working notes for all the number. We take special care of inflation nominal rate for discounting. We need to look at how much working capital is required year on year basis additional. We also need to remember at the last year, you don't need to invest into working capital. Actually, working capital will give you additional money. And also remember that in the last year, you don't need to make the investment for the asset to sustain the project. If you consider these 4 or 5 things, you'll be on track. Okay. Do you want me to write down somewhere? Okay, let me write down here for you, and you can note it. Key takeaways. And of course, this is not for all the NPV related question, like so far what we have done, just summarizing, because this is the core concept, or most of the ideas are related to this approach, right? You will have in further sessions some tweaking required for the tax, but most of the concepts for NPV revolves around these points. So number 1, what you need to do. Can someone help summarizing what are the key takeaways? Just in case I miss anything. So first, year 0 investments in the project. 2, focus on specific inflation rates. Don't use same rates unless told. 3rd, there are a number of negative cash flow in year 0. Factor all of them. 4, working capital is dependent on the next year contribution. So add incremental cash investment into the working capital. Don't invest in working capital in the last year. Rather, there will be a release of working capital, which will be positive cash flow. Don't invest in asset maintenance in last year, because it is required for next year always. Lastly, if we use inflated number to estimate the cash flow, always use nominal rate of discounting to calculate the NPV, which is 1 plus real rate times 1 plus inflation rate, and then don't forget to minus 1 as well. So these are few points that we should always take care in investment appraisal calculations for NPV. And once NPV once you grasp all this idea, even the calculation of IRR and various other things will be quite simple to understand. Of course, maybe I can just write down a couple of other points. Don't factor sunk cost. Okay. Don't factor sunk cost or committed cost. If you have committed to something already, that is not going to be relevant for NPV calculations. So don't factor sunk cost or committed cost. But do factor opportunity cost and use present value, etc. if needed. When depreciation will come, we'll talk about the treatment of depreciations and taxation as well later on, but this is most of the concept for NPV. If you want to note it down, you can note it down. I can leave it for a few seconds. And in case you have any other questions, feel free to ask. Anyone? Okay, so spelling. Okay. So if you have no question and you have noted down all these key takeaways, we can finish the class now at this stage. In the next sessions, we are going to talk about some other nuances within NPV, how to calculate IRR, modified rate of returns, etc., etc. Okay, so fabulous. Thank you so much for the class. And if you have any question, you can still let me know, and we can revisit any remaining questions in the next session as well. And take care, stay safe, and enjoy your remaining time. Thank you.